Good afternoon, ladies and gentlemen, and welcome to SA Stock Picks, an online stock analysis series brought to you by the JSE, where we ask independent industry experts to unpack their top picks for the week and why investors should consider them for their portfolio. I am your host, Adele Hutton, and I'm joined by a panel of market experts who hold a wealth of industry knowledge and experience. Chantel Marx, who is Head of Investment Research and Content at F&B Wealth and Investments. David Shapiro, Market Commentator from Sasfin Securities. Cabelo Mosesa, who is an Analyst at Mazi Asset Management. And then also a newcomer, in addition to Cabelo, is Nandi Keka, who is Head of Research and Fund Management at Nedbank Private Wealth. A very warm welcome to my panelists. Now, a lot has happened in the last 3 months in the market. Just to paint a picture, you think about the JSE FTSE All-Share Index hitting historic 100,000 point levels. Interest rates are low, inflation is low, although when you're at the till, I'm sure there's something completely different in your pocket. Gold has hit record highs, and then we got smacked with some sweeping tariffs from the US. So the market is as clear as mud, but opportunity abounds, and that is what our panelists are going to be sharing with us today. So before we dive in, just a quick reminder to the viewers, questions can be posted online via YouTube, so please do that. We'll try and attend to those questions towards the end of the show. So without delaying any further, Chantel, let's break the ice. If you could think back to when you started your investment career, what do you wish you had known then compared to what you know now about investing?
So I wish I wasn't as enthusiastic about mergers and acquisitions, because invariably they always end up, at least in the short term, destroying investor value. I think sometimes you do get acquisitions and mergers that make sense, but usually it follows a period of 4 or 5 years where that integration is taking place, and it's actually really, really tough going. I'm actually going to talk about one of those companies today, but I wish I knew that you should probably get out and then wait for a better entry price.
Okay, pearls of wisdom. Chantel, do you mind then kicking us off? What are your top 3 picks?
Well, I'll start with just saying that you mentioned the JSE reached record highs recently, but there have been so many companies that have had absolutely no part in that record high. So the 3 companies that I'm going to highlight basically are all trading at pretty depressed valuation levels. And one of them is actually trading around 5-year lows. I'll kick off with that one because it's also the merger or the acquisition rather hit company. And it is a kind of mid-cap, mid-tier miner. It's called Afrimat. They made a pretty sizable acquisition 2 years ago of Lafarge Cement's South African assets. And the integration has gone a little bit, I think, tougher than what they expected. At the same time, this company also has a big iron ore operation, and we saw iron ore prices come under a lot of pressure. And also at the same time, they had to revalue some of their iron ore inventory. They had some troubles at some of their anthracite mines. And with all of this combined, it resulted in them really coming under a lot of pressure from a financial perspective, and the share price following suit. But just for reference, prior to 2025, the 2025 financial year that ended in February, this company had made an economic profit, which means that its return on invested capital, so the money it spends on acquisitions and on investments, exceeded their cost of funding for their entire history. They have an extremely strong management team. They're very, very hands-on in their approach. And from what we understand, the Lafarge acquisition is now bedded down, and we are starting to see a big improvement there with demand for their products also picking up. South Africa is set to become a construction site over the next few years if all goes to plan. And this company plays in construction materials, and as we've already mentioned, cement as well. We also think we're past the cyclical lows from an iron ore pricing perspective. So the expectation is that things will start going a lot better for them. They'll already return to profitability in their 2026 financial year. And we think after having taken on quite a lot of debt to fund the Lafarge acquisition, they'll probably be in a net cash position in the next 3 years. Apart from that, they're still trading at 5-year lows. So the company looks exceptionally cheap. We still have momentum towards the downside, so you could be a little bit early, but if you're a long-term investor, this is definitely a stock to look out for. The second pick, Pepkor. Pepkor has lagged the JSE in terms of returns over the last year, very much in keeping with the rest of the discretionary retailer sector, even the broader retail sector, because we've got a few other stock picks in that space as well, where we really have seen share prices come under pressure. But Pepkor actually delivered excellent results when they last delivered results. They are growing quite quickly. Their store rollout program is progressing quite nicely. And one of the things that I really like about this company is that they're becoming a meaningful player in terms of the fintech space. So within fintech, they are doing so much. One of the examples that I like to use is Phone Yam, where you can actually kind of finance buying a smartphone. I think it's not only excellent from a business perspective, but it also promotes financial and broadband inclusion. And there are so many programs that are being run out of their stores that actually kind of bring people into the formal economy. And outside of that, they are starting to really push into underserviced areas, or continuing to push into underserviced areas in South Africa, and bringing a lot of people into the formal economy that way as well. Pepkor is trading at a multiple that is well below where it has traded at on average in the past, with a growth trajectory that I think is probably a little bit conservatively estimated by analysts within the market. It's a high quality operation, also producing economic profits, rock solid balance sheet, and from my perspective, a very easy long-term buy at current levels. And then my final stock is Sun International. They released very underwhelming results just earlier this week or late last week. And I think that it's if you look into the detail, there's a little bit more to get excited about outside of just looking at the headlines. They've seen some really good go forward momentum in their hotels and resorts. We still don't have travel or the international travelers reaching pre-COVID levels. And on top of that, we're seeing a lot more tourists as opposed to travelers. So not just people coming to South Africa, visiting family, or coming to South Africa on their way to somewhere else, but people actually coming and enjoying our country. So I think that portion of their business should continue to benefit from a return to pre-COVID levels in terms of travelers and tourism. And then the online betting operation, they've disclosed some figures for us now. They're continuing to see very, very strong growth. They've got excellent market share in that space. I think they have the scale to continue to grow and to outgrow some of the smaller competitors when and invariably when regulation becomes an issue in online gambling. I think Sun International is exceptionally well placed to deal with that effectively and to do things in the correct way. It's also a higher margin business than kind of the traditional casino space. The only issue for Sun International, I think, is the traditional casino space. Footfall has been under pressure and player engagement has been under pressure as well. But they've also admitted that there's a lot they can do in terms of rejigging their offering there, making it entertainment hubs as opposed to only having it have to kind of fall back on the casino and gambling side of things. So I think that there's scope for a recovery there as well. The share is cheap as chips. It's trading on a 7 times forward PE. And while you wait for a re-rating, you can also enjoy an over 9% forward dividend yield, 9.5% forward dividend yield currently on Sun International. Again, very similar to Pepkor on extremely conservative estimates.
Wonderful. Thank you, Chantel. Some really I dare say, cheap options, but with lots of opportunity that comes with it. It'll be interesting to see how Sun International manage their transition strategy, I guess you can call it, from their urban casino footprint, moving into the online betting, which I think holds a lot of opportunity. Right, so great picks. Thank you, Chantel. With that, I'm going to ask Sir David Shapiro. David, would you, let's go back again to that question. And I know you've got a wealth of experience behind your name. Looking back to what David thought about investing back then compared to what you know now, what do you wish you had known back then?
I think, when we first started on the market, or when you start out as a young enthusiast, you just want everything. You're like a kid in a toy shop. You want every stock, you want everything that's going up, and you still see it in the market today. And I think as you get wiser or stay longer, you realize that, you can make money just by holding a handful of shares. And, my whole motto at the moment is, if you can't do it in 20, in fact, even 20 is a lot, you're not going to do it in 200 or 2,000 or 3,000, whatever it is. So I like to keep things very simple, and I tailor my clients' portfolios accordingly, just very narrow. I call it like the Premier League. If I'm going to add one, I have to drop one. Who's getting relegated? Is the one I'm adding better than the one I'm dropping? It's a discipline. That's why I'm saying you're like a kid in a toy shop. You just want everything. And every time a good company comes, I got to add it. No, is it better than the worst one you've got, kind of thing? What are your top 20? So that's how I run, very simplistically.
Thank you. That's probably the wisest information, that from the very beginning. Keep it simple, right? So, David, who are your team picks then for your Premier League this time around? Your three choices.
My three choices are quite interesting, and the reason that I just want to make one point clear. A lot of people are asking us, how do we reconcile? And I think you try to allude to this. How do you reconcile the stock performance or the performance of the JSE with an underperforming economy? And, you mentioned a lot of it has to do with the performance of gold shares, platinum shares, and a lot of shares that don't do any business in South Africa. But if you look at the SA economy, it's pretty weak. And, around that, it made our choices very difficult. It makes choosing companies very difficult, simply because even Chantel's, if you listen to what Chantel said, even Sun International on the local casinos, things are pretty tough. Afrimat battling against very low commodity prices and so on. So I think we've got to understand that, it's still a battle for local businesses. But I think I've got three companies. Oh, the other thing I want to say, and if you listen to Chantel as well, and I'm sure we're going to hear it from our other guests as well, is that our private sector just never fails to display resilience. And there are always businesses like an Outsurance or We Buy Cars that are rewriting the rules. And that's what I love about South Africa business. But I've selected three companies that have been around for some time. And for most of their lives, they operated in the shadow of much larger, dominant players. They were overlooked and underestimated, but I don't think anything more. And obviously, the first choice that I have is Capitec. This was a small bank that was launched in 2001, founded by Michael Leroux, Rian Stassen, and Yanni Mouton. And they used the discarded Boerland bank license, after Boerland merged with Nedbank a few years before. They used that license. Understand that Capitec was created in the aftermath of a merger, of the merger of Nedbank, but also of the formation of ABSA. ABSA was a massive merger, Volkskrust Trust Bank, United Building Society, Allied Building Society, and so many more. So understand where its roots were. And, in a book, his recent book, Craig Martin, Boerland Bank is Behaving Badly, he attributes the collapse of Boerland Bank to the reckless leadership, unauthorized bonuses, dubious financial practices, and many more, of that happened during Boerland Bank's time. And he suggests that many of these patterns actually re-emerged in Capitec's formative years. So the conclusion in Craig's book, not a surprise to the market, Capitec has faced huge challenges in its relatively short existence, including that notorious Viceroy report. So it's been called everything from a risky micro-lender to an overpriced loan shark. And for this reason, I was actually reluctant to include it today, until a group of banking friends of mine admitted how scared they were of Capitec's entry into the corporate market. So Capitec today is largest retail bank by customers, over 24 million customers, has a market cap of 401 billion, which is in line with First Rand and Standard Bank. And just if you think of their humble beginning, today the market cap is higher than the combined market cap of ABSA, combined, I said, ABSA,
Wow.
Investec, and Nedbank. So why does it matter? It's monopolized personal banking, and it's positioning itself to become a very meaningful force in the in the corporate business. They're uncomplicated products. They give uncomplicated products, and they built a lot of trust around their customers. And if you'd invested 100 Rand in Capitec 20 years ago, it's worth 28,600, which is a total return of 33% per annum. So my second choice, another underdog, Shoprite, which now leads the retail sector. It was founded in 1979 when Whitey Basson acquired small, I think about 8 grocery stores in the Western Cape. And that gave him the base to fulfill his vision of serving the mass market. And at the time, Pick and Pay was the darling of the industry and the JSE, and totally overwhelmed other players. It acquired Checkers in 1991, which was a upmarket chain, that was struggling financially. You remember Twally for Twally? The move the move allowed Whitey to triple its size, and also move into major financial centers. And he now serves, both the low income and the middle class markets. Today, Shoprite is the largest food retailer with over 3,500 stores and a market cap of 164 billion Rand. It just leads the other retailers in all metrics: revenue, stores, employment. And when Whitey retired at the end of 2016, there were deep concerns that Shoprite would lose that entrepreneurial edge. But Peter Engelbrecht has continued his legacy and is just taking Shoprite to another level. Their 60/60 is revolutionized grocery delivery. It's just outdoing all its competitors. But the group is also a leader in technology, using AI tools to improve efficiency and mix. Why does Shoprite matters? It's just built a brand loyalty on understanding its needs. Just remember what they did during COVID, reduce margins and prices, and customers have never forgotten that. So not quite the returns that you've got in Capitec. Still put 100 Rand in there 20 years ago. It's worth 2,700, or a total return of 18% per annum. And my final choice is what I call a quiet contender that's finding its voice, and that's Momentum. Always been a bit player in insurance, dwarfed by Old Mutual, Sanlam, Liberty, and Discovery. And that shows in its returns. Over 20 years, if you put 100 Rand into Momentum, it's worth 1,000 Rand. That's still a decent return of 12.25% per annum. But that's because of the kind of recent surge in the company since about 2022. So if you look at a chart from 2015 to 2022, the share price was in decline. But in July 22, from July 22, the share is up nearly 190%. And one's got to attribute the success to the return of former CEO Hillie Meyer in 2018 and the appointment of his deputy CEO, Jeanette Marais, at the time. Hillie retired in 2023 and Jeanette became CEO. And together they refocused that business and streamlined the company's structure. They had faced shrinking new business, declining earnings, and falling share price. But their reset and grow strategy stabilize the business, reclaim market share in both the affluent and low-income segments, and improved efficiency in all operations. I just think that while Hilly stabilized the group and genetics has accelerated its growth, they have modernized their beliefs and culture. It's shifted from what was an unremarkable contender to a very impressive force in financial services.
Thanks, David. I mean, that just again shows the importance and the power of, and not to discount, what great management can do for a company.
Yeah.
Again, momentum particularly, and even ShopRite, like you alluded to earlier on. And I guess the biggest task, I think, for all companies now is how to modernize, given that things are changing so quickly. How do you stay up to speed with what the consumer needs and wants, at the same time also staying true to your values and your brand? Some great picks. Thank you, David. Right, let's move over to Cabelo, also a first-time panelist on Stock Picks. Cabelo, I want to pose the question to you now. Going back to the early days of Cabelo when first entering the investment world, what do you wish you had known then compared to what you know now?
Yeah, sure. Yeah, thanks for having me. My key thing would have been proper consistency, and just to break that down, it would have I would have probably told, well, at least would have followed the approach to follow better, higher quality stocks, or stocks that need less closer looks or everyday checking, because back then it was more about which stock is going up when, and holding a volatile, changing that portfolio often, whereas that consistency over time, having a good set of companies, periodically reviewing it, less aggressive, and having a longer term horizon would have probably yielded a better outcome than having a portfolio where you're looking at every data point every single day, trying to extract value from every single stock. So that probably would have been that's the one thing that I enjoy doing now than the stressful period that I had in my earlier years.
So not to panic, hey? Just don't panic every time,
100%.
hey? Yeah.
100%.
In for the long game.
Yes.
Right. So shall we dive into your top 3 picks?
Yeah, sure. So, I mean, overlaying my picks, the theme is definitely, as David mentioned, is the SA macro remains tough. So what overlays them is self-help and obviously and an attractive valuation with some exposure to regions outside of South Africa. So the first one I'll take, I'll go through is Woolworths. So we're very familiar with Woolworths. It's a food retailer with its origins from Cape Town, and they've carved a unique niche in terms of particularly in food and clothing, and they've got operations in South Africa and Australia. What that unique niche allows them to do is offer value versus chasing pure, having the lowest prices on shelf, and that's what drives their ability to service the middle to higher income consumer better than peers. Post the sale of the David Jones as acquisition, well, that transaction, once they completed that, that has allowed management to focus more on the returns of its core businesses, which are the food and FBH, or fashion, beauty and home, and Country Road, versus chasing top line growth as they had in the past. We think the EBIT margins in their fashion, beauty and home business, as well as Country Road, are at cyclical lows and could recover from this point post the completion of their key initiatives. We've seen them invest in the past 3 years quite aggressively in terms of in the form of capex and other into tech and logistical activities. And what could be supportive in the near term as well is a recovering consumer environment. We see that improving profitability and the declining capex, post FY26, they're guiding to that capex slowing. That could support the company generating higher cash generation and then being able to reduce its net debt. We like the current valuation; it's attractive, and it mainly reflects the food business. And that attractive valuation is confirmed by the company's recent announcement of that share buyback program. The next stock is Pick n Pay. We're very familiar with Pick n Pay, have gone through a few turnarounds in the past, but we think this time it could be different. They're a South African food retailer. What we like about it is, given how large Boxer has grown, in the background and their clothing business, what that allows them to do now is have access to the faster growing middle to lower income segments. Whilst the Pick n Pay core business, they're not focused on growing that. It's more about turning around the prospects of that business. That company has also seen reduced influence from the Ackerman family. Now we believe the board is able to focus on the interest of the broader shareholder group. And then the completion of its, the successful completion of its recapitalization program, they stand with a strengthened balance sheet that moved from a net cash to a net debt, debt to a net cash position, so much stronger than it was in the past. And then its operating performance and cash flows could improve, supported by the company's current strategy, which involves planned cost reductions, putting in place effective leadership, rolling out its store modernization program, and then improving its product offering and logistics. The current valuation, similar to Woolworths, is very attractive as it doesn't reflect the other businesses. It mainly reflects at this point in our view the Boxer business. And then lastly, also have a pick in the banking sector, but my pick is Standard Bank. This is the largest, largest bank in Africa by assets, with a broad footprint in Africa that supports its diversified income streams. Its exposure to higher growth, higher return African markets underpins superior earnings growth versus peers that are mainly focused in South Africa. We think the recent business unit changes have accelerated the digital innovation, where they've simplified the segments to focus on the specific customer groups. And then the successful integration of Liberty has increased the group's client focus and improved their prospects in terms of delivering stronger growth. The company has a strong capital position, and which supports both organic and inorganic growth, particularly in Africa. And then with that capital position, there's still scope that management has guided for potential share buybacks. That we think over and above that, the company's share price could benefit from a re-rating, an earnings multiple re-rating, as it now starts trading within that revised ROE range of 18 to 22 from its previous 17 to 20%. Which is more reflective of its peer, the likes of a First Rand, if we were to use a proxy. And that's where I'll leave it.
Thank you, Cabelo. Just to go back to your two retailer picks, Woolworths and Pick n Pay, it is such a competitive space. If you look at how they're trying to engage the customer more acutely, the online presence, the fact that Woolies has that Bellville offering, I think it's that's spectacular customer experience shop that they've rolled out. I think it's Bellville, I stand corrected. But really trying to change the way that they engage with the client and how the client engages with them. Similarly with Pick n Pay, obviously they're going through a bit of a turnaround, if I can call it that. But that huge competition with Checkers 60/60 and how they're trying to, I guess, play catch up, I think is commendable. I think their partnership with F&B, I think, has gone really well. So those are some interesting picks to keep our eye on for sure. I think let's move on to Nandi. Again, the question to you, Nandi from way back when, wishing that she had known about investing then compared to what she knows now, what would you tell Nandi?
Sure. I wish I had known then how deeply uncomfortable investing can be, how very, very difficult it can be to watch a call you've made go against you for a very, very long time. And I guess what I know now is that investing ultimately is a game of mastering your emotions. It's not necessarily about how smart you are, about how complicated your spreadsheets are. It really is a game of mastering your emotions. And I think that's something I know now that I wish I had known then.
Right, so I'm assuming that today's picks are devoid of emotion and just pure logic.
At least one of them has tested my emotions, definitely. And maybe I'll start with that one.
Yeah, please go ahead.
Right. So my first pick actually is Spar. So I'm throwing another retailer in the mix. Yeah, so Spar is a share that is deeply unloved by the market currently. Yeah, look, the business has faced a number of challenges over the last few years, underperforming businesses, particularly in their offshore markets. They had an SAP system implementation almost 2 years ago now. That was disastrous, to say the least, and massively impacted the profits in their South African business. Debt has been on the high side. And I think it's fair to say that Spar has not kept pace, with the likes of Shoprite and Woolies Food. However, where we are today, I think the outlook for Spar is much better than what a lot of people, I think, give it credit for. Where we are today, you have an almost entirely new management team at Spar, who've shown the ability to make difficult and necessary decisions. This management team has shown that they do what they say they're going to do. And what have they done? So they've exited Poland, which is a market that they went into around 5 years ago, I think around COVID. Destroyed a lot of value in that market, but that is now behind us. So as of January, they've exited that market, and that's done. They've also initiated the process of exiting their businesses in Switzerland and in the UK. And in fact, this morning, Spar confirmed that they have, in fact, found a buyer for their Swiss business, which I think is a big positive. Again, those two businesses haven't really added much value to Spar as a group. In terms of the SAP system issues, yeah, look, I think the issues have been bedded down. Fixes have been implemented. The system has been optimized. And we've already started to see a recovery in the profits of the South African business and those operations. And I expect that recovery to continue over the next couple of years. With regards to debt, they've restructured their debt. So debt repayments look a lot more manageable now. I think there's better alignment in terms of debt repayments with the recovery in profits of the South African business. And cash flows. The sale of the Swiss business actually also goes a long way to reducing debt in the overall Spar business, so that you had a lot of debt sitting in Switzerland, which is now being sold off. And then lastly, I think when it comes to their South African business, as I say, really have failed to keep pace with the likes of Shoprite and Checkers, but with the exit of all of these offshore markets that really haven't added much value, I think management now has a renewed focus on the South African business. I think they now have the capacity to implement the initiatives that are necessary to position Spar to be better able to compete with the likes of Checkers and Woolies. So overall, I'd say the outlook for Spar today is a lot better than it was a year ago, and a lot better than what the current share price suggests. So that's the first pick. And then on the second pick, I'll go with Bidvest. So Bidvest is a well-established, well-run, well-positioned company that owns a portfolio of underlying businesses, and these underlying businesses provide products and services to other South African businesses that span the spectrum of the South African economy. So Bidvest has exposure to the automotive industry through their large network of car dealerships. Their freight business facilitates the export and import of mostly commodities. They have a consumer product segment or division that provides products and equipment to a variety of businesses. So if you think about, the equipment that an electrician or a plumber would need, Bidvest provides those kind of equipment. And then the largest part of their business is the services business, and this is largely facilities management. So they offer the service to big corporates. So if you think about the security guard who looks after your office building, or the team that cleans and maintains that building, if you think about the hygiene equipment you would find in the bathroom of a shopping center or an airport, Bidvest provides those types of services. So they have 7 segments overall across various sectors, and 2 or 3 of these business segments have been underperforming recently. And I think, or my view at least, is that that's really a temporary issue. It's not anything structural or permanent in nature. And then David also alluded to, the weakness in the South African economy, and being a sort of GDP play, if I can call it that. I think a lot of negativity is now baked into Bidvest as a result of, I think the lower expectations around economic growth, etc. But I'd say at current values, the full potential of this business really isn't reflected in the share price. And I think the last point on Bidvest that I'd make is that the CEO has been buying shares in the last few months, and that's usually a good indicator in terms of their view of the outlook for the business. And then my final pick is a stock that's a little bit more global. So AB InBev or Anheuser-Busch is my last pick. So AB InBev is the largest brewer globally. So they make and sell beer really in just about every part of the market, and they own some of the biggest beer brands in the world. If you think of Budweiser in the US, Corona in Mexico, Black Label in South Africa, those are the kinds of beer brands they own. And I think really the key attraction of AB InBev is, you've got a globally diversified earnings stream. So this is not a business that's reliant on the South African economy performing. You've got exposure to, businesses or operations in all parts of the world. They sell a product that is consumed habitually, so people drink beer in good times and in bad. So demand is pretty stable and predictable. Look, I think volumes in certain markets or certain of their markets have been under pressure recently. So in China and Brazil, you have seen some volume pressure in terms of beer volumes. However, that is offset by the other markets. And that's really the attraction of a well-diversified businesses. When 1 or 2 markets are underperforming, it's usually offset by some other markets. But I think where we are now in terms of the current share price, the full sort of strong and sustainable earnings power of this business is not fully appreciated by the market. So we really do see AB InBev as undervalued at current levels. And those are my 3 picks.
Thank you, Nandi. It'll be interesting to see, particularly with AB InBev, there's a global movement around reducing alcohol intake, either fewer drinks or having a low alcohol level kind of drinks. But interesting how some of these really big beverage companies would change their strategy or mold with the times as consumers' needs and tastes, if you will, change, and how that translates into earnings ultimately.
Yeah, so Adele, actually, AB InBev has moved in line with that change in winds, if I can call it that. So they actually have a category called Beyond Beer. So they make products for consumption, whether it's at home or in restaurants, etc., that aren't quite beer. Some of them are non-alcoholic, but you also have products such as Brutal Fruit. So they really have recognized that move and shifted their strategy to be able to capture that change in sort of consumer tastes and preferences.
Brutal Fruit. Oh, you take me back to my varsity days. Oh, a long time ago. Right, so we've got a bit more time. So I want to encourage our viewers to, again, a reminder to please post your questions online. We have a couple which we can dive into. This is a question from Just in Case. Just in case. And the question is, what is the panel's thoughts on Altron, seeing that the price has fallen quite, well, significantly from 21 Rand to about 18 Rand? I'm not sure who of the panel would like to take that question on Altron.
I'm happy to take the question on Altron.
Thanks, Chantel.
So, I mean, Altron really has been under pressure more recently, and it's actually been quite disappointing because they've done so well in terms of repositioning that business over the last few years, and areas that are quite exciting like health tech and fintech, and really kind of a consistent, stable growth profile in the Netstar business. But there are some other bits and pieces within that from time to time kind of upsets the balance within that business. And I think what we saw with the last trading update was just that some of those kind of gremlins started creeping through again. But I think if you're looking at Altron from a very long-term perspective, you need to decide if you are positive on vehicle tracking, which I think most people would be, because it's not only vehicle tracking, it's also the data and the logistics surrounding that. Are you positive on the fintech offering, which I think you should be positive on, particularly given how buoyant that space is in South Africa? And then I think health tech is also an area that still has a lot of room for growth. But Altron, you'll have to wait it out. You are going to get these periods of volatility coming through, and I think that this is just one of them.
Thank you, Chantal. Right, a question maybe for David. This is from Mashamba. Can Old Mutual and Sanlam partnering, can they evolve like Capitec in the banking industry?
In essence, yes, simply, but because I think if you look at Old Mutual and Sanlam, I mean, they have massive bases. I think what differentiates Capitec is that it's built this loyalty over 20 years by offering just those very simple services. You know, you don't go into a Capitec branch and see these pillars, these marble pillars or something. And I think as a result of that, it's dominated what we'd call the low end of the market. And it's using that base to elevate. I always thought that Old Mutual could, as a bank, simply because of its reach at the lower end, you know, through selling low end policies, challenge them. We haven't seen any progress yet there. I'm not sure whether Sanlam also wants to go in. You know, they've announced that they want to go into banking. But I think it's not that easy. You know, everybody, even ShopRite wants to go into banking now.
Wow.
In terms of it has customers and offering simple, kind of simple products. So it's getting a bit crowded at the moment. And I think that for Mutual and Sanlam to go into that, it's going to take a long time to actually get their customers to think of them in a banking space. You know, so I like Mutual at the moment, and I like Sanlam where they're placed in terms of where the economy is going. And you know, we are seeing an uptick. They look very cheap. They look very juicy, you know, in terms of returns and that. But I'm not sure they're going to knock Capitec out. I think it's going to be a very, very hard challenge to take them out of the banking side. But they do have the basis. That's what I'm trying to illustrate. It's how they use it, you know, will differentiate, and whether they're creative enough to use their customer base to do that.
Right, thanks, David. Yeah, just again, a reminder to our viewers, before time runs out, to please post their questions in the comment section of my YouTube. A question for perhaps Cabelo. This is also from Just In Case. What do you think, this is regarding Met Air, and do you believe they will be affected by US tariffs? You know, if, don't know if you want to take this question, otherwise we can pass it on to someone else on the panel.
Yeah, I mean, I don't want to mislead the viewers, but I think if anyone else has a
You
stronger
are
opinion,
Chantel.
Okay,
yeah,
yeah,
thank you, Chantel.
Yeah, so I mean, one of the things that I've said in the past is that
Just,
if you look
Cabela, don't feel bad. It happens every time on TV with her. You can't knock her out. So just accept it, okay? Just take it.
No, so I looked at this because we got a lot of questions from our clients asking which industries are going to be most exposed, which stocks are going to be most exposed, and Met Air produces the goods that go into these original equipment manufacturers' vehicles that they are apparently exporting to the US. But Met Air actually in their last update said that none of the OEMs, the original equipment manufacturers that they service, actually are exporting vehicles to the US. So their exposure is going to be quite limited, particularly in a direct way. Perhaps in an indirect way, through import displacement, you could see something happening, but directly there isn't going to be much of an impact. Met Air, by the way, is also just an extremely cheap stock, but I think you have to back a recovery there and a continuation of an improvement in vehicle export volumes in South Africa to get like full comfort with the investment case.
Thanks, Chantel. Right, I think we might have space for another one or two questions. This is from Jenny or Jennifer Hiley. And this is an open question to the panel, whoever wants to take it. Your thoughts or views on Aspen? Any takers from the panel?
I'll take that one. Yeah, look, another, I think, lesson in mastering your emotions, Aspen has been. Look, I think where we are today, there's a lot of skepticism around anything Aspen management says in terms of guidance and prospects. Market really giving very little benefit of the doubt in terms of a recovery. From a valuation perspective, I think it is undervalued. It is cheap. So essentially within Aspen, you have two businesses. You have a commercial products business where they essentially distribute branded products that they don't, branded pharmaceutical products that they don't necessarily manufacture. And then you have a manufacturing business where really that's where the issues lie. So you have all of this manufacturing capacity. Most of it is sitting latent or idle. So they really need to get customers in and get contracts in to fill that capacity in order for that business to be economically viable. And where we are currently is they've lost one of the biggest contracts in that manufacturing business. So as of their FY25 results, you have a 2 billion rand earnings hole that's been created. And it'll take some time for management to, replace that contract, to go through the regulatory hurdles that will, help them cement capacity or to fill that capacity. So I would say Aspen is very much for the long-term investor. You really need to be patient and have faith in management's ability to secure those contracts and to fill that capacity. Yeah, I think valuation-wise, you're really only paying today for the commercial product business. You're getting that manufacturing business for nothing, but that business is basically unprofitable at the moment and for the foreseeable future. So yeah, I think you really have to back management here and take a view on their ability to fill this manufacturing capacity.
Wonderful. Thank you, Nandi. And with that, we are running out of time. A sincere thank you to all of the panelists today, Chantel, David, Cabelo, Nandi. Really do value your time. For the viewers, thank you for dialing in. You can view this recording on YouTube. Also visit our JSE website, jse.co.za, for further information. And we hope to see you again. Thank you. Cheers.